bright and lovely morning. My name is Priscilla Koo, your UOBM Invest Buddy, and I'll be your host and moderator for this webinar. So let's start out with some housekeeping items for you to take note. If you have any connectivity issues, you can raise them to the Zoom host via the chat box feature. Polls will appear on screen for your selection and results will be shared. For this webinar, there will be 2 polls. Click on the Q&A icon to ask questions throughout the session. Click the like button to upvote questions raised in the Q&A section. Please note that this is a public webinar and will be recorded. Click on the links available in the chat box to access the UOB Invest corporate website, to download the retail app and the feedback form. We're excited to share on the agenda today. We'll start off with an introduction about UOBAM and UOBAM Invest, followed by a fireside chat with Damo in regards to UOBM Invest corporate latest change and announcement. We will end this webinar before lunch with a Q&A. Kindly raise your questions in the Q&A section, and which can be found in the control panel. Please note that questions raised in the chat box will not be addressed. Thank you for your kind understanding. And for those who can stay tuned to the end, we will greatly appreciate if you could complete the feedback form. A quick introduction for those who are not familiar with UOB Asset Management. UOB Asset Management is a leading regional asset manager that has investment experience of more than 30 years. We are wholly owned by UOB, one of the strongest banks in the world, and are present in 10 markets in Asia. As of 31st December 2021, we have 38.7 billion assets under management and won 211 awards since 1986, including the Best Ace Asset Management House Singapore Award. At UOBAM, our purpose is to create value for our investors, partners, and communities, and to help them achieve their goals and aspirations. Our vision is to be a trusted asset manager in Asia, leading in innovation and sustainability. UOBAM is one of first regional asset manager firm in Singapore to join the UNPRI, which stands for UN Principles of Responsible Investment. So what is UOB Invest? UOB Invest is a digital platform offering investors guided and personalized investment service. It is available as a mobile application for personal investing and as an online web portal for businesses. We are the first corporate robo-advisory in Singapore, and we turned 3 last October. UOB Invest makes corporate investing simpler, smarter, and safer. UOB Invest corporate online platform launched in October 2018, which offers corporate investors both guided and independent approaches. Head to our website. The link will be shared in the chat box and later again at the end of the webinar. To find out more of our latest promotion and for more information, with a minimum of 200,000, corporate investors can start their digital advisory journey with us. Boasting as the first digital platform in Singapore to offer online investment advisory to corporate clients, you can monitor and plan your portfolio holistically. It is 24/7 accessible online web portal. You can access it either on your desktop or even your mobile phone via HTML. Exclusivity by tapping on our fund manager's capabilities, offering proprietary ETF selections and asset allocation view. A credibility and track record of more than 30 years as a fund management company, making us one of the most awarded and trusted fund management companies in the region. We'd like to take a poll to see from our audience today, are you an existing UOBAM Invest corporate client? A, yes. Fund direct only, yes. Direct digital advisor, yes. Both fund direct and digital advisor, no. But I am a UOB Invest retail client, no. But I am interested to learn more, no. But I like to attend learn at UOBM webinars. Wow, we have a split of a 50-50. Thank you for answering our poll to share results. Yes, so we have a combination of a digital advisor, corporate clients, and also retail app clients. Thank you so much for answering the poll and sharing this. Thank you. So today's webinar, the title is Learn at UOB Optimizing Your Investments with ETFs. As part of our regular review to optimize corporate digital advisor investment, we replaced most of the unit trusts with exchange traded funds with effect from 5th March 2022. So let's learn more about the latest change from our speaker today. Our speaker today is Mr. Dharmo. He's our Chief Investment Strategist at UOB Invest. He is responsible for providing leadership in the investment aspects of UOB's digital platform. He is also concurrently heads the Investment Partnerships and Solutions unit at UOB, managing the firm's strategic tie-ups and investment initiatives with external managers. Dharmo has over 20 years of investment and research experience in the finance industry. Good morning, Dharmo.
Good morning, Pris.
Nice to
start my video.
Sure, yeah. Nice to see you. I mean, it's bright early morning. Thank you for joining us. Before we proceed with the fireside chat, I think we would like to know, hear from our audience today. What are your top current market concerns? Is it inflation? Is it geopolitical crisis between Russia and Ukraine, COVID-19 and its variants, and others? Wow, astonishing.
Okay.
Wow, astonishingly, okay, we'll just end the book. Yes, so results. Yes, so currently our audience right now, as you can see, the top concern is inflation, and also a number of people are concerned about the geopolitical crisis between Russia and Ukraine. Thank you for answering the question. So, Dharmo, can you share with us what is UOB's current market outlook, and what should investors, especially corporates, should take note in these upcoming months?
Okay, sure. Right, great. I think it looks like there are quite a bit of concern on inflation, maybe a bit of geopolitical crisis between Russia and Ukraine. Okay, let's look at what happened this year since the beginning of the year. I think when we first started, I think inflation was probably the key concern, and because of that, there were concerns that central banks around the world will have to increase interest rates and increase it very aggressively. I think at one stage, the expectation was that the US Federal Reserve would increase interest rates by 7 times, or roughly speaking, by about 1.75% over this year. That was really, really aggressive. I think that would probably be one of the most aggressive that we have ever seen in terms of central bank tightening. But I think what happened was that, of course, Ukraine and Russia happened. And initially, I think most people thought that Russia would not invade Ukraine. I think most analysts were thinking that Russia already made its point and it doesn't need to invade. It has probably achieved its objective. But instead, Russia has gone on to invade Ukraine. And I think what has changed as a result is that because of this geopolitical uncertainty, now the expectation is that central banks will not be so aggressive, because given all this uncertainty and its impact on the economy, central bank would probably not rate hike as aggressively as previously expected, especially if this becomes a long-drawn event, right? So if this gets settled quickly, then maybe we should be looking at about 4 to 5 hikes. But if this gets long drawn, the number of hikes we see this year might actually be even lower than that. And that's starting to be discounted in the market, right? So that's why at one stage, 10-year US Treasury yield hit 2%, is now back to about 1.75 around there. So that's actually now starting to be priced in, that the Federal Reserve will not be as aggressive in terms of hiking rate. And this is probably the current consensus right now. And this is despite the fact that inflation, if anything, is probably still very stubborn, right? The whole conflict basically means oil prices continue to go up. And if anything, there are quite a number of other commodities being affected as well, including metals like nickel, where Ukraine is a big producer, and also soft commodities like wheat, in which that Russia and Ukraine are a big producer, and there could really be some supply disruption as a result. Okay, so basically, I think the long and short of it is that inflation would actually continue, and if anything, worsen in the short term, simply because of all this supply disruption as a result of this conflict. But the long-term view is that inflation probably comes down towards the 3 to 4% range by end of the year or early next year, simply because at this current rate, on other products, what we are seeing is, of course, the sort of supply bottlenecks is gradually being eased. Things like semiconductor, the supply is starting to increase. And the other thing is, of course, what we've seen, although there's tight labor supply, so far the wages have not really gone up that much around the world. So basically what we've seen is that the expectation is that inflation would not persist in the long term and probably come down to a more moderate level by the second half of this year. It will be still higher than what the world is used to, in the sense that I think before 2020, the world was running at an inflation that's below 2%, and there was actually a lot of stimulus trying to get it up to 2%. Well, we got our wish. Going forward, I think inflation will run at about 3 to 4%, but definitely not the 6-7% that we are seeing today. Right, so that's roughly speaking where we see the world. If I may add, the expectation now is that given the heavy reliance of Europe on Russian energy, they basically rely on imports of Russian oil and Russian gas. This increase in price and this energy supply constraint would likely mean that Europe might go into a recession if this conflict persists any much longer. I think that's really probably the point of concern. However, we think that that's probably fairly isolated in the sense that US and Asia probably still have sufficient economic momentum that we would probably be able to go through this without seeing a recession. And I think that recession will be more localized in Europe simply because it's really of its dependency on Russian energy. So I think that's probably the other observation. And on that note, the expectation is that euro is probably going to be one of the weaker currencies, one of the weaker major currencies this year compared to the US dollar or even compared to Asian currencies. Okay, back to you, Pris.
Thanks, Damo, for sharing that Market Outlook in snapshot. I know it's a lot of things are happening, even on a daily basis. Things are developing, the new news are coming out, and of course, at UOB Asset Management, be rest assured, we have our investments team like Damo and a huge team that actually updates. I mean, they have a discussion every morning meeting, and just kind of like figure out things every single morning and just putting our investors, our clients ahead of us, considering the risk and everything. So thanks, Damo, for sharing on that. There are a couple of audience here also today that maybe are new to UOBM Invest. Can you just share with us how does UOBM Invest work in a nutshell?
Okay, UOBM Invest for corporate clients obviously has two parts. One is, of course, the robo-advisor, and then there's the Fund Direct, which is basically a fund platform for corporate treasurers and corporate offices to invest your excess funds, especially if you think that you want to invest in things like money market fund to get a better return than what you put in a bank, right? And if you have a longer duration, or you can set aside money for a longer period of time, there's some of the short duration bonds that we recommend to corporate treasurers and offices to use in terms of generating higher returns for your idle cash. And of course, we do have the robo-advisor, and the robo-advisor are meant for clients who have a moderate to long investment horizon. And when I say that, I mean somewhere around 3 to 5 years at least of investment runway. What we do is that we take into account your risk profile of the corporate, of the company, and with that, we allocate your funds into a portfolio and a mixture of equities and fixed income based on our expected risk return profile of each asset class. And we tailor a customized portfolio for you so that it would continue, it would basically build a balanced portfolio that generates even a better return than, say, just a short duration bond fund, which probably gives something like 2% return annually in this current environment. So if with a corporate robo-advisor, with a robo-advisor, an aggressive portfolio may be making somewhere between 4 to 5, even up to 6% based on our experience.
Awesome, thanks Darryl, for sharing that. So we just made a announcement recently. So we just want to understand what is the latest UOBM Invest Corporate Digital Advisor CMA? What's the underlying holdings, the change? Okay. If you can just update us, yeah.
Sure. Let me share my screen with you and give you. Right. Okay. Let me get this moving. Okay, right. So basically, these are some of the changes that we made for the corporate robo-advisors. Okay, and these are what you see on the first column are the various asset classes that we invest in for the corporate client in the robo-advisor. Depending on the risk profile, it may be a blend of some of this. Usually it's not a blend, it's not all, but it's a blend of some of this portfolio. So what we've done is, in the past, there was some asset classes in which that there are either unit trusts or ETFs, and in some asset classes is actually even 2 ETFs. What we have done is that we've basically tried to streamline it, and we have also converted for most asset classes into ETFs rather than in unit trusts. Excuse me. The one exception is probably in the cash equivalent, in which that we don't find any appropriate ETFs out there, so we continue to use our money market fund. But otherwise, for all other asset classes, we've converted them into ETFs. And in this instance, there are a few things that we've done. I think if I may elaborate, for some, we've actually reduced the duration. What I mean by duration is sort of how long, what sort of maturity of bonds do we invest in, right? So in the for example, in US government bond, we used to have two ETFs, that's 7 and 10-year Treasury, and then there's a US Treasury bond ETF. We used to invest about 50-50. Today, we only invest in the US Treasury bond ETF, and that bond ETF actually has a shorter duration than the 7 to 10-year Treasury bond, right? That invests in bonds that are about 7 to 10-year maturity. Why do we do that? I think when we planned for this, the concern was, of course, there will be an increase in interest rates, and the longer the duration of the bond, the more sensitive and the bigger the impact is it on the bond when interest rate increases. So what we're trying to do is sort of make the bond portfolio be less sensitive to interest rate impact, right? So that's one part. The second thing that we've done is really on the Asian bond side, on Asian bond and on Asian high yield. What we've done is we've expanded the geography. So instead of just investing in Asian bond, we invest in emerging market that probably has a similar profile, return profile as Asian bond, but increase the diversification in terms of geography. And the reason is that in the Asian bond space, a big part of Asian bond is really Chinese bond issuers. And if you remember, late last year, early this year, there were quite a number of default by Chinese bond issuers. And because of that, the Asian bond market suffered, right? So there were quite a bit of ripple effect on the rest of the Chinese issuers, and Asian bond market suffered together with that. So for us, expanding that geographical scope to emerging market, we think diversify the risk while giving roughly similar return to what we expect from Asian bond, and which is the reason why we went into this. For others, for example, like the high yield bond, so we simply switch ETF because we found a better ETF. The ETF market is obviously not static, and when we can find something better, lower fees, or better tracking performance, we do try to deliver the asset class performance with the best the best ETF we can find out there. So that's roughly speaking the kind of changes we made for this portfolio. And on the equity side, it's the same thing. All right, so what we see in the past was that there were some in which that there are two ETFs. We basically switch it to simply one ETF for efficiency in terms of our trading and our portfolio management. For asset class like Asia ex-Japan, we are now investing only in ETF rather than in unit trust as well. Okay, and there are some reason for that. I mean, what is the difference between ETF and unit trust? ETF, of course, is sold on exchanges versus unit trust that's sold on bank branches and by financial advisors. ETF tends to be managed in a systematic way, whereas unit trust tends to be managed actively by fund managers, and ETF usually have lower fees versus unit trust. So these are some of the differences and the sort of advantages of ETF. And the reason, and in terms of choosing the appropriate ETF, we tend to look for a few things, right? We want to look for ETF that has a low tracking error, meaning that these are ETF that tracks the benchmark very closely and deliver the full performance of the benchmark as close as possible, right? So if, for example, we use a US ETF, US equity ETF, let's say S&P 500, we want to find an ETF that tracks the S&P 500 very, very closely, right? Usually for these ETFs, the tracking error is about 1%. We don't want ETFs that have, like, say, for example, 3% tracking error, meaning that if the S&P goes up by 10%, you are only delivering like 7%, right? That would not be a good ETF to track the S&P 500. And then we look for ETF with low management fees. That's because we basically want clients to benefit most from the ETF performance. And so we try to find one with low management fees and low total expense ratio, right? And then we want ETF that's liquid so that when we make any changes in the portfolio, if we need to get in or get out, the market for that ETF is very liquid, and it makes it easy for us to do that transition. Fourthly, we basically look at ETF manager. We want reputable ETF manager with strong investment and risk management system, because what we are mindful of is that ETF, we always say, is asynchronous in nature, meaning that it tracks the benchmark. So the best that you can achieve is really track the benchmark. But if your ETF manager is not good, then basically the downside is that you miss the benchmark by quite a bit. So to us, we really want to find a good ETF manager, and we basically evaluate that investment and risk management system, right? So how would the latest change affect the portfolio? I think there are three reasons why we instituted this change, and probably the most important reason is the one in the middle, number 2. What we've seen is that market has been very volatile. I think you've seen it in January, given that the expectation of central bank tightening, and then of course now the geopolitical risk in Ukraine and Russia. And because of that, sometimes we see active manager, being whipsawed by all this volatility because of the emotional aspect, right? So we basically rather invest in the asset class without having to take into account the emotional aspect. So we think that in this environment, it's difficult for managers sometimes to overcome the emotional aspect of investing, and there might be, as a result, underperformances in terms of the portfolio. So for us, we rather simply take the asset class return. And ETF basically delivers that. It just delivers the asset class return. It doesn't try to beat the market, but it would generally not underperform the market as well. So we rather take that than taking on the fact that active managers might underperform, or even if some good ones may outperform, we rather not take that volatility in terms of outcome, right? So we rather just take the asset class return. That's really the most important reason why we basically made this decision. Secondly is, of course, with the low, we think that in this difficult investing environment, having lower fees is better than paying higher fees, and ETF gives us that outcome. And thirdly, as I mentioned, we streamline in terms of the implementation by using one ETF asset class, which basically streamline the efficiency and probably make it easier and reduce the drag or the friction that we have. Instead of having to execute 2 trades, we now just simply execute 1, right? So that's basically what we are hoping to achieve. So these are really the 3 main reasons why we made these changes to the portfolio. And basically, we hope that this would probably achieve a better investment outcome for our investors. So why invest with UBM Invest Corporate? Basically, the system is simple to use. You choose how you want to invest. You can track all your investment and stay up to date on your portfolio. We give you web access in which that you can self-serve, and you can at any point in time see where your investment is, right? It is smart. It's the robo-advisor is customized portfolio for your company. It's designed based on our proprietary investment models and our investment expectation for each asset class, right? And then it is safe. It is set up for authorized with authorized users roles, and transact basically with a safe payment mode. So basically that's all I have today. So back to you, Chris.
Thanks, Damo, for sharing with us. Yes, if any of your audience have any questions for Damo, please help your, you can just raise your questions in the Q&A in the control panel, and all questions, you can even view other people's questions and upvote questions. I have a question for Damo personally. You mentioned a lot of good things about ETFs at low fees, they're not static, and you look at ETFs that has a low tracking error of 1%, things like that. I think it's good that we have a lot of benefits, but also can you share with us, is there any cons or something to consider when you're looking at ETFs?
So basically, ETF, there's a few things that is against ETF. So that means in ETF, there is no upside in the sense that if you invest with an active manager, a good active manager may be able to beat the market in the long term, right? So basically, over the long term, if you find a good manager that has a good investment approach, it may deliver better than market performance. ETF doesn't offer that. ETF simply mimics the market and basically try to do that. That's the first thing. Second thing is, of course, tracking error is built in. So although we say that they try to mimic the market, there is still going to be several basis points of fees and expense ratio. And in terms of execution, there may be some lag. So there's always that little bit of tracking error in the ETF. So it will not be 100% tracking the market. It would probably miss the market by 1 percentage point or around there. But over time, obviously, that becomes amplified, right? So if you miss the market by 1%, over 5 years, that's going to be 5%. Over 10 years, that's going to be 10%. So that's basically the basic inherent nature of ETF, simply because of this tracking error effect. But it is probably as close as we can get in terms of tracking of buying the market. Right, so those are probably the two shortfalls of ETF.
Thanks, Damo. I know sometimes it's very difficult to do everything. There's a pros and cons, and also with things to consider. There are some of our own existing clients who are our digital advisor, corporate digital advisor clients attending this webinar. Are there? Can you give a bit of a insight, or can you share with them what are the things that they may see since the change on 5th of March? Would there be any certain change that they can foresee, or any advice for them to as they go along with us throughout this uncertainty of this year? Yeah, if you could, any words that you want to share with them, that would be great.
Basically, we are still, we're constantly monitoring the market, and we are constantly watching the portfolios. So definitely it's something that we are thinking about. If this, for example, if this becomes a full-blown crisis, what we would probably likely do is probably raise a lot more cash for the portfolio, and we can do that simply by telling the model to set aside more cash and reallocate. Allocate the portfolio probably in the same way as how you would go about, but simply raise the amount of cash so that we reduce that volatility in the portfolio. That's probably one thing that is on our mind. We have not reached that stage yet, but it's something that we always have as a toolkit in our toolbox, right? And obviously, if things do settle down a bit, we may consider switching back to funds, but at this moment we think that not having emotions being involved in the portfolio is probably a big plus. So that's why we've done that. But it's something that we also are keeping it at the back of our pocket in terms of our implementation. And definitely as things evolve, we constantly update our expectation or our assumption in terms of the return profile and the volatility profile of each asset class that goes into the robo-advisor, and the robo-advisor would basically, as a result, rebalance that portfolio accordingly to achieve the outcome. So basically, what we expect is, given that the heightened volatility, especially in equity markets, I think what you've seen is really quite a bit of whipsaw in the market. You see, say, US market up 2% one day, down 2% another, for several days, and basically that typically increase the volatility of the market and in terms of our expectation as well. So what clients might see is that at the rebalancing, given that we try to keep the portfolio to a certain risk profile or to a certain volatility target for each client, we would probably allocate less equities and more fixed income in the portfolio going forward. And this is also partially because now, given that we think the upside risk for interest rates has been lowered, right? Because we started the year with expectation of 7 rate hikes. I think that number has come off. So we think, given the Russian conflict, and especially if it persists, the chances of interest rate going up is now much less, and therefore having a bit more money in fixed income may not be such a bad thing, especially if we use it as, especially if it sort of reduces the volatility of your portfolio.
Thanks, Damo. I know that was a difficult question. I also gathered that I've encountered some clients, not just corporate, but also from a retail point of view. Because of all this uncertainty, a couple of investors asked the question, should I exit now and then enter into the market again when things are more stable and pick up? For this kind of investors, I understand that ETS, we're doing ETS because we want to remove that emotional investing, and it's sometimes very difficult when it comes like to make any kind of decisions. Is there any particular advice you can share with those who are a bit uncertain right now, a bit emotional, things are hot up, and they're a bit concerned, should I exit now and then enter into the market when it's better? Is there any advice you would like to share with them?
Okay. For those people, our experience is that we tend to exit when fear is at its peak, what we call maximum fear, and then we don't know when to get back into the market, because when market tends to move even when things are not totally clear, right? So if you remember, in 2020, markets started rebounding even when COVID was still really bad, right? In 2008, markets started rebounding even though the GFC was not over yet. So market tends to move ahead of the facts, or confirmation of the facts. So a lot of time people tend to miss that. People think that they can catch the bottom, but it is really, really difficult. And if you miss that strong rebound in the initial phase, you tend to miss out a lot of the returns that you have. What we've seen in terms of studies, and this is a sort of long-term study that people have done, is that most investors don't benefit from the full market return because they try to trade in and out, they try to time the market, right? So to us, we try to advise clients to be more focused on time in the market than timing the market. So So we basically advise not trying to catch that, not trying to time that market, because most of the time we get it wrong. Even professional investors get it wrong, right? So what we usually do is advise clients either, I know it's difficult, but there are a few ways. If you're really adventurous, we always say, try to be contrarian. When people are fearful, that's when you start buying. But even if you don't have that, stomach, what we advise is basically dollar cost averaging, right? Simply sort of putting money regularly. If you put a fixed sum of money regularly, when things are down, you are buying more. When things are up, you're buying less. So basically, you're always buying cheap, meaning that when it's cheap, you buy more. When it's more expensive, you buy less. And over time, this strategy tends to deliver a very good investment outcome.
That's awesome, Dharma. Thank you. I also share the same sentiments, and also the time in the market, it plays a very important, and also that's because of compounding also. So yeah, thank you, Dharma, for sharing with us your earnest feedbacks and sharing with us today. I gather that it's a very intimate group today, and there's no questions from the audience. So thank you, Dharma. I'll just move on to the next segment.
Sure. Thanks, Chris.
Dharma. Now, if you'd like to find out more or read up on our UOB Invest Digital Advisor latest performances, you can scan this QR code with your mobile phone or click on the link shared in the chat box to access our latest performance webpage. Our performances will be updated on this site on a quarterly basis. The one that is in right now that we have is the fourth quarter 2021. For the first quarter of 2022 will be released in April, first 2 weeks of April. Okay, next slide. Right, we want to partner with corporate investors in their wealth management journey and leverage on technology to allow us to bring to them a simple, safe, and smart way of investing. For corporates interested to know more, you can visit our UOBM Invest website. The link will be shared in the chat box, or leave us your details in the feedback form and we will contact you after the webinar. And to our existing corporate clients attending this webinar, thank you so much for your support. And thank you for attending this webinar this lovely morning. Before you go, please click on the feedback link and leave us a feedback. All the questions in the feedback form are optional. You can also scan this QR code that will be displayed. So I will just move on to 2 slides. Yes, so you can scan this QR code to access the feedback form. We will greatly appreciate your feedback. Leave us your contact details if you would like to hear more from us. And if you have any issues receiving our updates, please let us know in the feedback form. We have been sending out market updates quite frequently. And if you have subscribed to us and have yet to hear from us, please do let us know. And if you like to know or follow our mailing list, please leave your contact details with us. Now, thank you, Dharma, our special speaker today, and especially to our audience attending this webinar today. Have an awesome day. Stay safe and goodbye.